6 financial planning questions a middle class family must answer before joining the upper class. You've worked hard all those years and it's finally paying off. Financially speaking, your family is comfortable. Now that you're part of the middle class, how do you grow your burgeoning wealth and ensure it is optimally passed on to the next generation? Here are a few reality check questions you must regularly revisit with all members of your advisory team, including your accountant, lawyer, and other financial advisors. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic today. I'm doing marvelous. And if you are doing as marvelous as I am, go grab a cup of coffee or tea or let's roll. Today I want to talk about 6 important questions that a middle class family must answer before joining the upper class, the 1%. All right. Question number 1. Have all family members received the proper level of financial education? Are there gaps in the financial education here? When I'm talking about financial education, I'm talking about money management. So, budgeting, how to really understand the difference between credit and debit, expenses, income. It is very important because as you're trying to grow your family, as you're trying to catapult your family into the upper class, you want to make sure that all members of the family are financially literate, because a mistake by one family member could actually, bring down the whole net worth of the family. So it's very important as you discussed with with members of your advisory team, make sure that all important relatives are good when it comes to financial literacy. So I talked about money management, so spending, savings, budgeting, the use of credit cards and debit cards. Those are very important. So you want to have some kind of protocol in the family when it comes to using plastics. Savings, if the saving strategy is centralized or decentralized. In other words, if advisors are taking care of the savings, or whether or not each family member is entitled to their own saving strategy. Those are questions you need to think about. Real estate. Real estate is also an important thing. You want to identify whether or not the real estate strategy is at the family level, in other words, centralized or decentralized. Why? Real estate particularly entails large amounts of cash over a long period. The last thing you want is a family member going, behind the scenes and signing a property deal that will basically obligate the entire family over 30 years, right? So you really want to think about financial education and make sure there are no gaps in that type of education, very crucial education at the family level. Again, if you have a large family, you want to focus on the key players, the key individuals, the key relatives that are essential to the family's net worth. All right, that's the first question. First question, have all family members received the proper level of financial education? Question number 2, do we have the appropriate amount of life insurance? Now, life insurance is very important for those who are sort of new to life insurance. Life insurance basically ensures that your survivors, or your spouse, if after you die, your spouse or your children receive some kind of cash and they can continue living normally. They can keep their standard of living even after you pass away. Now, it's very important not to have gaps at that level. So you want to figure out whether you are underinsured, whether all members of the family are underinsured, right? So you look at things like mortgage, college tuition, utilities, food, clothing, debt payments, and make sure that all those expenses can be covered by the proceeds of the life insurance. All right. Now, if need be, under the tutelage of your advisors, members of your advisory team, you want to think about whether or not you should increase coverage, right? You want to increase the amount of insurance you currently have. Now, there are other situations also that would force you, or would compel you, if you will, to increase your coverage. For instance, if your income changes, you buy a new house, you get married, you have children, you buy a second home, a vacation home, all of those things have an impact on your insurance. Now, you also need to choose the right type of life insurance. Again, as your life changes, you want to discuss with your advisors what kind of life insurance you need. Do you need permanent life insurance? Do you need like whole life, right? Do you need term life? Do you need, so because permanent life insurance, such as whole life, is for life, as long as you pay your premiums. Term life is good for people who want a cheaper policy, because you only need a policy during your high earning years and you won't have a large estate to leave behind. All right. Now, it's very important never to go without coverage. This is very important to get the right coverage here. Now, the thing is, please do not buy group life insurance. A lot of first generation middle class families want to stick to group life insurance. It's not enough, right? Because employers often will offer group life insurance to employees because those are generally low cost or no cost, right? But you want to get something extra, right? So you want, in those policies, group life insurance pays very low death benefits. All right. And the thing is that your employer can even take away coverage later. So there's no guarantee that it will be there when you need it. So you want to get something privately. All right. I'll be right back for the 4 other questions you need to ask yourself. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still here having a conversation around important questions that a middle class family must answer before joining the 1%, the upper class, becoming wealthy. If you like this kind of content and you appreciate the clarity of the content, consider subscribing to our channel right now and turn on the notification bell so you are informed whenever we drop a new show. We produce shows every single day, and like this content, share and comment below. Question number 3: have the family dynamics changed? For example, a recent birth, adoption, marriage, divorce, or death. Those are very important, right? Changes in the family dynamics will have an important impact on the financial situation of the family. For instance, getting married, you have new individuals entering the family, so you might want to update your beneficiaries when it comes to life insurance. You might want to maybe tweak some investment strategies depending upon the direction that the new family member is or the new family members are taking, right? Now, if you have a baby, of course you have to think about not only changing the beneficiary, but also if you have a trust account, include that baby into the trust account. You have to think about college expenses, so the whole educational fund has to be replenished. Very important. If you have to send your child to college, depending upon the college you want to send your child to, you have to, so talk to your advisors about this. I'm talking about your accountant, your financial advisor, your tax lawyer. Talk to them about the implication of having a child upon the situation, the status, the financial status of your family. All right. We have the number 4. Question number 4: is our estate plan in sync with our family values, and does it reflect our mission? Let me repeat that. Question number 4: is our estate plan in sync with our family values, and does it reflect our mission? Now, this is also very important because when talking about a proper estate planning process, there are a few things you want to pay attention to. And as the family's situation or the family's dynamic evolves, you want to update those things, right? Now, there are a few legal documents you should have in place in every estate, and you want to update those documents regularly. So there's something called an advanced healthcare directives. An advanced healthcare directive indicates your healthcare preferences, and this is only used when you can't communicate your wishes. Another document that's very important is a power of attorney for asset management, right? You are actually thereby appointing someone to someone you trust to manage your financial affairs on your behalf, right? Now, there's something called a HIPAA release form. This allows the people named in your advanced healthcare directive and your power of attorney to access your healthcare information in dealing with insurance matters on your behalf when you can't do so, right? And there are two other elements, legal elements you need to remember here. And those are things you need to constantly review. Those questions you need to constantly revisit and upgrade and update, not upgrade, updates, right? You also have a will. So legally, the term will means, it's a document whereby you transfer your assets upon your death, right? That's where you put your beneficiaries. And you also have something called a living trust. Now, a living trust offers another way to transfer property upon your death, right? The thing here is that a living trust can be more confidential, faster, and more flexible in regard to distribution than probate. All right, so you want to think about those things as you think about your estate plan and make sure that that estate plan reflects the mission of the family. Now, it's very important to make your final arrangement before they're needed. As I said earlier, you want to update the beneficiary forms, right? If you have a death in the family or a birth or a divorce, whatever, you want to update the beneficiary forms when it comes to life insurance, annuities, or retirement plans, right? I'm talking 403b, 401k, IRA, or others. Okay, but normally when it comes to those, to life insurance, annuities, and other and retirement plans, your spouse should be your primary beneficiary, and then your children. But again, this could be a charity, it could be good friends, it could be a pet. Really depends, right? You also want to start thinking about, having a clear list, an updated list of your assets. And I'm not even talking about just physical assets, also your digital assets, right? We live in a world of where internet has some kind of prominence here, and you want to make sure that all your bank, brokerage, and credit card accounts, you have to think about, your passwords, your access information, your authentication records. All those things has to be taken care of in advance. So this allows the trustee, designated power of attorney, or executor to access your accounts as needed. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having a conversation, a wonderful conversation that is, around the questions that a middle-class family must answer before joining the upper class. Now, question number 5. Is our family's investment portfolio optimally structured with respect to asset allocation, manager selection, fiscal planning, and the mix between liquid and illiquid holdings? This is an important question, right? When it comes to investment, under the tutelage of your advisors, you will discuss how to determine the appropriate asset allocation, right? You have to think about what's really important for the family and all the individuals in the family. You have to discuss also again, when it comes to asset allocation, we're talking where to put the money. Let's just put it in simple language here. Where to put the money? Are we buying stocks? Are we buying bonds? Are mutual funds better? ETFs, options, currencies, whatever it is. Under the guidance of your advisory team, you can make that determination, right? You have to also think about the selection of the manager. So we're talking here about the person or the company that will manage your wealth to sort of help you pass on this to the next level, to the next generation. You want to think about, at that discussion, you want to reassess portfolio weightings to make sure you can rebalance them again accordingly to your vision, to the family's mission. There is also a fiscal element here, a fiscal planning element involved here. So if you have to talk to your tax attorney to make sure, or your CPA, your tax accountant, to make sure that things are comfortably taken care of at the tax level, that you have no worry to have when it comes to estate taxes or inheritance taxes, all that kind of stuff, or gift taxes for that matter. Another thing that's very important here is that you want to think about the mix between liquid and illiquid holdings. Now, liquid just means you can sell an investment and very easily. And illiquid means you just have to wait a little bit before you can sell it, right? Some holdings are liquid, some holdings are illiquid. Now, it depends on the liquidity strategy of your family. Do you need cash in the short term, or if not, just then invest in a vehicle such as a company, for instance, right? Where to actually get out of to actually sell the holding, it will take a while. So that would be illiquid versus something that is very liquid, a stock, a company stock. You just buy this on the New York Stock Exchange and just you can sell it. So think about that mix during that conversation with your advisors. Now, the last question that you need to ask here is, do we have an appropriate trusteeship strategy in place? Let me repeat that. Do we have an appropriate trusteeship strategy in place? Now, this just means that you are reviewing the list of trustees, and you are trying to make sure you have the right people, because the trustees must be impeccable stewards of the family wealth, right? So the thing here is that you want to make sure that the existing trust structures consider the preparedness of the trust beneficiaries, right? You want to make sure that your trustee choices still make sense based on the circumstances, based on new factors, on new elements, because things change, right? So if you 5 years ago you thought this person was a great trustee, and you just realized today that he or she didn't meet the standards that you were looking for, then you can change them. One thing you also want to make sure is that you want to make sure the trustee himself or herself is still willing to serve, right? Because this has to be a win-win. It has to go both ways, right? So ask yourself, as you're trying to review your trusteeship strategy or your trusteeship plan, make sure that the trustee or trustees you choose are capable, qualified, and willing to serve as trustees, right? Another question you want to ask yourself is, by naming this particular person as trustee, will that hurt family relationships or cause problems down the line, right? Because again, when you think about wealth management and wealth planning, you're talking decades. You're talking, intergenerational wealth management here. So any decision you make, any person you choose, any person you appoint, think about the short term, but most importantly, the long run. After you're gone, what will happen, right? Another question you want to ask yourself is that the trustee, does he or she provide continuity and protection against malfeasance? In other words, if there is fraud, if something is happening, does this particular person safeguard the wealth of the family? So those are problems that you really, really want to think about, right? I'll give you an example. Let's say you have a trustee, and again, I said earlier, 5 years ago, he or she was fantastic, and all of a sudden you realize that he or she has some drug problems, some drug addiction problems, right? So the person is no longer qualified. The person, no longer has the intellectual integrity needed to take care of the family's wealth. So you constantly want to change those. Constantly want to check those things. All right. When it comes to a good trusteeship plan, you want to think about three things. You want to make sure the trustee the trustee you choose enables your company to get three goals: liquidity, so you have enough cash to maintain your lifestyle; longevity, so again you have enough cash to improve your lifestyle, especially in your golden years; and the third thing is legacy, that you have enough cash, or there is enough cash in the family's portfolios to improve the lives of others, right? I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are about to wrap up today's conversation, and if you just joined us, or you've been following us for a while and you appreciate the clarity and the quality of today's content, please consider subscribing to our channel. We cover a lot of interesting topics, and we always appreciate when viewers give us a positive feedback. We really appreciate it. Subscribe and turn on the notification bell so you are informed when we drop a new show. We want you to share this content. People need to know this. Like, comment below, give us your opinion. We really appreciate it. Now, what was the context of today's conversation? You have worked hard all those years and it's finally paying off. Financially speaking, your family is comfortable. Now that you're part of the middle class, how do you grow your burgeoning wealth and ensure it is optimally passed on to the next generation? In this show, I've given you a few reality check questions you must regularly revisit with all members of your advisory team, including your accountant, lawyer, and other financial advisors. Now, there are 6 important questions, and here they are. Number 1, have all family members received the proper level of financial education? Number 2, do we have the appropriate amount of life insurance? Number 3, have the family dynamics changed? For example, a recent birth, adoption, marriage, divorce, or death? Number 4, is our estate plan in sync with our family values, and does it reflect our mission? Number 5, is our family investment portfolio optimally structured with respect to asset allocation, manager selection, fiscal planning, and the mix between liquid and illiquid holdings? Number 6, do we have an appropriate trusteeship strategy in place? So those are basically the 6 questions you need to ask yourself. And I want to give you a pro tip before we wrap today's show up. You want to generate income. Work periodically with your wealth managers to devise and agree on strategy that help your family generate income, right? Secondly, strategies that help your family protect assets and preserve capital. And the third thing is manage taxes, right? So anytime you meet with your advisors and you ask the 6 questions I just gave you, at the end of the conversation, the outcome of the conversation should be, how do we devise and agree on strategies to generate income, more income for the family, protect assets and preserve capital, and manage taxes in an optimal way? All right? Thanks for listening, and I will see you next time. Until then, stay marvelous.